Welcome to another accounting video, and this is part 4 in the, revision series. I'm going to call it the revision series. I might as well name it after part 4. But today we're going to be looking at theory, and in particular the assumptions, qualitative characteristics, and a bit of an unpacking of how I would answer theory questions. So, just a reminder, part 1, we talked about the journals, so our cash receipts, cash payments, sales journal, purchases journal. We did those, we totaled them. Happy. Next, we did our reports. We did the cash flow statement and the income statement. That was part 2. Part 3, we looked at the balance sheet and the theory behind it. And now we're looking at the characteristics, assumptions, and how to do theory questions. So if you're stuck on anything, again, you always need to ask your teacher. It makes a difference. So on that note, let's crack into it. So let's bring up the work. Again, this document is going to be available on Compass. So assumptions. So first assumption, accounting entity. The assumption that the records and activities of the business are kept separate from the records records and activities of the owner. Yeah, I did spell from wrong. I spelled it form because I'm good at English. So we need to make sure that when we look at accounting entity, when we define it, we're going to make sure the records of the business and the owner are separate. The thing that makes these separate is drawings and capital contributions. So they're the two that always link to the entity assumption or the accounting entity assumption, where it's the business records are here, it's its own thing, and the owner records, business records. They can't be together because that's wrong. You'll end up double counting something. That's why we keep them separate. So if the owner wants to give something to the business, then that can happen. We've got the period assumption. So this is the assumption that reports are prepared at specific times consistently. This is to ensure comparable results that can be used to assess performance. So you might say quarterly, monthly, yearly, or you might go half yearly, whatever. Like, you can't compare a month to a quarter because that wouldn't work. So the idea of period is essentially we want to be able to compare. The accrual, we got the accrual assumption. This is the assumption that ensures revenues are recognized when earned, while expenses are recognized for whatever reason, spelled with a Z, when incurred. This means that profit is calculated as revenue for a particular period minus the expenses incurred for that period. So the first main example that ensures this is the income statement, and that's what the income statement's a measure of. And then from that, you would say stuff like credit sales. Let's get rid of the underline. So credit sales is probably the main one because we recognize it before we've got the money. So we recognize it when it happens. That's the only real one you're going to look at. It could be stuff like discount, revenue, expense would be one you would tie it to. The other one you could also do might be inventory gain or loss. The accrual assumption is a lot more prevalent in 3.4, but there are aspects of it. We now have the going concern. The going concern, this is the assumption that the business will continue forever with no end date. So the business has an infinite lifespan, and that's because it is separate from the owner. So the idea is the owner dies, business can continue, ultimately. Where were we? This ensures that reports and records of the business are created on this basis. So what we do is we go non-current assets, because if we didn't have this basis, we could just say that every year the business is going to end in the next year. So our van would always be a current asset, or our loan would have to be paid back at the end. So it's what creates that different, that non-current, current, oh, there we go, current split in our assets and liabilities. So that's what ensures the going concern. So you can see that these, we've all looked at that. So we've looked at the monthly report in this example. We looked at both drawings and capital contribution. We did an income statement and we had credit sales and inventory loss. So we had all those. You've seen those. You've got the going concern, and that's the non-current current split in our assets liabilities. Again, evidence here, current asset, non-current asset, current liability, non-current liability. All right, now we've got characteristics, and our characteristics ensure our our reports embody this. I'm just going to close that door. All right, relevance. So the first one, relevance. That the financial information presented must be capable of making a difference to decisions made by the user. So if I use this, the information included, will it help with decision making? And we use something called the materiality test, and it's a good test. This can be included in budgeting, predicting, or evaluating. Now, the materiality test is, will this have a significant impact? For example, if I round up to the nearest dollar, so if it's like $90.10, that 10 cents rounded down or the 90 cents probably not going to make too much of a difference. But if we're excluding thousands or tens of thousands of dollars, obviously that's going to have a bigger impact. So that's where that balance comes in. So what ensures that is including changes in cost price for inventory. So for example, it goes up from 90 to 100 during the month. You could imply that instead of saying everything costs 90, that's material. Also, other things you can include is the cost of an asset in terms of your budgeting as well. So when we evaluate, we've got to look at, should we include this? Faithful representation. This is a popular one, especially for inventory cards. So any information presented must reflect the real-world economic events it claims to represent. Must be free from bias or material error. So anything you pick up, they go, yeah, no, it makes sense. I get it, and it like you got something to link it back to. So I think the best one we did was inventory count, but you could say valuation of assets when we do non-current assets, like when the van was donated or purchased at $3,300. It's faithfully representing what happened. So these reports reflect the transactions. So for example, if for the van I paid $3,300 plus GST for it, but instead I make the value $10,000, that's not a faithful representation of that reality. So that's where that comes in. Inventory count, you've got that, valuation of assets, even valuation of inventory was in there, because some people like, we could say faithful representation because we're not valuing it at the sales price, we're valuing it at the cost price. So that was good there too. Verifiability, any information presented should allow for independent observers, not observes, man, my English is weak, to reach a consensus/agree that the event is as reflected. The most easiest way to ensure verifiability is by having source keeping and providing source documents. Now, how we ensure verifiability in our all this information? Quite simply, have a look at our invoice numbers. Have a look at our receipts. Have a look at our checks. All source documents. Shocking. Now, comparability. Comparability, any information presented should be able to be compared with similar information about other entities or the same entity for a different period. So, for example, Easter period reports, same methods of cost used, inventory costing used, there we go. Used, except, I'll put that there. So for example, if I'm Coles and I'm going to look at the last I'm looking of the Good Friday to after Easter Monday, and I would look at that year on year. I wouldn't compare that to the Christmas period because they're very different. But at the same time, if I'm going to compare my business to Woolworths, and Woolworths are using FIFO, and my supermarket's using identified cost, I can't compare them because we're using different methods. So that's just something to be aware of. Likewise, if I change reporting, like how I do my inventory, I can't compare my reports because I'm using different methods. Next, we have timeliness. Any financial information presented should be done within a time frame that is capable of influencing decision makers or users. So, best example I can think of, and I'll just add that there, examples to ensure this, is budgets. Budgets or comparison reports. So, for example, if I want to budget for Christmas, to see how we're doing, it would make sense for me to receive the budget before Christmas, right? Because I need to know what will happen to make adjustments. If I receive it after Christmas, it's not timely. It's not going to influence decision making because it's like, well, that's useless because it's Christmas 2025, so I want it in November 25, not January 2026. Super awkward because of that budget. Understandability, hopefully I'm doing that with you guys. Any irony. Let's try it again. Understandability. Any financial information represented should be understandable / comprehensible to users with reasonable amount of knowledge. Should be clear and concise. So this is formatted reports. So any reports you make should be clear and understandable. So if we go back up, we go to my reports, we can see this balance sheet should be able to tell us what are our current assets, what are our non-current assets, what are our total assets, and then we look at the equities and we can get an idea of how this looks. And we can see that people can understand this. It makes sense. Same with the income statement. If I go back to the income statement. See, it's understandable, 3170. You can even say that about the bank balance here. It just shows, do we understand? Now, I have highlighted this just to make the extra point, but that's how that looks. Now, we've done our characteristics. What are some things that I may want to include on certain answers? Now, this is a sample. You're going to have your own ones, so we're just going to work around. So, what qualitative characteristics is met with the transaction on the 20th of June? So we look at the transaction on the 20th of June. In this case, we have a look, 20th of June. We see they received 1,500 from Tim's Tools, receipt 104. The most simplest one is, say, verifiability, because we kept the source document. So you would mention or list / state the characteristic. Explain / describe the characteristic. And then link the explanation with what happened in the case study. Now, in this type of question, and generally theory, you'll be asked, what does this transaction prove? So you'll be given something to work with. I'm going to call it the case study for this, okay? This is the third one. A lot of people can state it. Some can explain it, but they can't link it. Linking's the hard one. For a 3-mark question, the third mark's always linking. For a 2-mark question, the second one is always linking. You need to be able to link. It's not even a matter of if, it's a matter of, well, better get this done. What accounting assumption would be satisfied with the transaction on the 31st? And I believe this was the drawing. So you, again, list / state the assumption. And then you explain / describe the assumption. And then You link the explanation with what happened in the case study. Nice and simple, very three-step process. All right. The owner wants to contribute his van, which has 5 years left, which has, words are hard. The owner wants to contribute his van, which has 5 years left, to the business. What would this be classified as on the balance sheet? Why? How you would answer this? You would state the classification. If it's a van, 5 years left, then you would say NCA. You need to go non-current or current and asset. If it's owner's equity, you just go owner's equity. Next, you explain the classification. So you would say what non-current is and what is an asset. So you would say what is both of these. That's how you would link that. And lastly, does anyone want to guess, using their brains, what it might be? Like everything else, it is link the explanation with what happened in the case study. I cannot emphasize enough how much or how important it is to link it. And every year, accounting students do not link. And that's what separates the kids that go, yeah, I got 70, I'm pretty good, to the kids that go 90 plus, the superstars. Because the superstars link the explanation. And you guys can do that. If you're watching this video, you're more than capable of doing that. So get out there and do it. So, looking at the results for January 2025, discuss why the owner would be happy or wouldn't be happy with this. Now, for a discuss, you need to include both sides. Please remember, you need to include both sides. Why they would be happy, why they wouldn't be happy. Right? At least one reason why the owner would be happy, and provide specific numbers. So, for example, if I was to look at the cash flow statement for this month, I would see, would he be happy with this? Yeah, because he's got money in the bank after his first month. That's awesome. So that could be one reason why. But then if I say, nah, he probably shouldn't be happy, you could say, well, drawings were high. They only had a net cash flow because of financing activities. You could say he's unhappy because from operations they lost cash. You could say they didn't make a profit. You could say the balance sheet that about half of the or a bit under half of the business is already funded by debt. So you've got a few different things as well. So look for previous numbers, look for industry averages, and you've got that. Look at trends. Even common sense is a fair play. Like, then if they made a loss, obviously they're not going to be happy, okay? Owner wouldn't be happy. This is one of the higher end accounting questions, and a lot of people can sort of state stuff, but then when it comes to backing it up or justifying their answer, they can't do that. And I think that's an important thing. Justification or discussion is such a key part of accounting. So hopefully you got some value out of these videos. I can't stress the importance of, if you're doing a theory question though, you need to be looking at why, and you need to be looking at linking the information in. It's not going to happen in accounting where I go in the SAC and go, define this, define that, tell me about this, or tell me about that. That's not going to happen, okay? So that's the important thing to remember. Anyway, on that note, thank you for watching along. 4 parts is a long time. So look after yourself, be safe, and please, 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 if you get stuck, ask for help. And like and subscribe. See ya.